You are listening to Keystone's Stock Talk Podcast, episode 63. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, in our Your Stock Our Take segment, we take a look at GlobalSCAPE Inc., symbol GSB on the New York Stock Exchange, a leading developer of software for the secure movement and integration of data. The company specializes in EFT, or Enhanced File Transfer software. A listener who had owned the stock on our recommendation points out the surge in the company's shares over the past week, asks what is driving it, and is there value now? Our star of the week is North American Construction Group Limited, symbol NOA, on the New York Stock Exchange. It's seen its shares rise 35% year-to-date in 2019. NOA provides mining and heavy construction services to customers in the resource development and industrial construction sectors, primarily within Western Canada. I would like to again thank my co-host and welcome him. That would be Aaron Dunn, Senior VP of Research for Keystone. Mr. Aaron Dunn, how are you?
Thank you. I'm doing good, Ryan. And obviously we've been busy here getting ready for our seminars coming up. And I think it's, what do they start? They start mid-April?
Yeah, mid-April. I mean, April 15th to the 25th.
15th to 25th.
Yeah, we'll be in 6 cities there, and I think we're actually going to head out to Eastern Canada, Toronto, and some cities out there sometime in the early part of May. But certainly we'll be in Kelowna on April 15th, Victoria on April 16th, Langley April 17th, Vancouver April 23rd, Edmonton April 24th, and Calgary April 25th, inviting current clients and would-be clients or anybody who wants to learn more about building a simple stock portfolio, how to look at stocks, how many stocks to add to your portfolio, what type of businesses, and we'll give you some specific recommendations to get you started in that respect. And we'll have some special topics like we always do. We have recently looked at the cannabis sector, blockchain, big data, AI, gaming stocks. We'll comment on all of those. Should you have those hot sectors or hot segments in your portfolio, or just buy some cash-producing stocks and become a boring millionaire? It's a great segment, 2 hours with myself and Aaron, and we also do at least an hour afterwards when we take questions on the seminar itself and on any other topics you have related to your portfolio or North American stocks.
One thing I really liked about the last set of DIY events that we did is that we stayed true to our core research. We talked about the small cap growth, the dividend growth, gave individual recommendations in those spaces. But we really went into what were the hot topics of the time, which was blockchain, cryptocurrency, cannabis, AI, big data. Some of those continue to be hot topics today. But it was interesting to me because by breaking down these sectors, I mean, I knew with the blockchain, with the crypto, several of the other hot topics that we touched on as well. I knew that they were highly speculative and there wasn't a lot of fundamental value in the companies that were operating in those spaces, but I didn't know how speculative it was until I actually started breaking it apart. And I really like to think that we saved, hundreds of people money by doing those events because we really steered them away from these highly speculative areas that continue to perform very poorly since the DIYs, and directed them towards good, growing, profitable companies that actually ended up performing well, generally speaking.
Yeah, and I think one of our major takeaways from like what to stay away from were the hyped blockchain and cryptocurrency segments, and that has proven to be very good advice over the last 6 months to a year, really, as that segment and anything associated with it has absolutely plunged. And what we did do is, like I said, we do 5 actual real recommendations typically at a seminar that you can put in your portfolio. One of the companies we actually recommended, this was in October of this past year, was a company called Questor, symbol QST on the TSX Venture. It was trading at $2.22 there. I think it trades at $4.90 today. So listeners or our attendees have literally had a stock more than double over that period. That was one of the 5 recommendations. So I'm sure that paid off their $29 to get in the door. So we provide you with things to avoid, suggestions on what to avoid, but also obviously we give those recommendations on what you should buy in your 10 to 20 stock portfolio to get you started. And there is just one example of a company that we recommended, and it's been about 4 or 5 months since then, and the stock has nearly doubled. Now, not every company we recommend is going to do that, but it was a cash-rich company, growing, trading at reasonable valuations, and the shares have surged since then. Certainly not a company that had a lot of hype behind it or was involved with the crypto or blockchain sector, but just performs. And that's what we think you want in the market is returns, not to invest in hype.
It's. I really think that there's nothing else like this our DIY seminar that we've done, and I'm not just saying that because I'm incredibly biased, which obviously I am, but yeah. I objectively speaking, I don't think that there's anything like it, where you have an opportunity to sit down, learn a little bit of practical knowledge that you can apply right away to your own investment portfolio, and then also be provided with several recommendations. We provided 5 last time, individual current recommendations that people can look at adding to their portfolios right now. And all of these companies have been vetted by us, analyzed by us. So every single one of these businesses that we talk about as being good potential opportunities are profitable, growing companies. And that's what's important. There's not enough emphasis in the retail investment community on investing in profitable businesses. And I truly believe that 80-90% of the risk that retail investors take can be eliminated or avoided just by focusing on profitable businesses and staying away from the speculative companies that are generating no earnings or in a lot of cases, many cases, not even any revenue.
Yeah, these concept stocks that people add to their portfolio can just be killers over time. And it really seems like like Aaron's talking about, just profitable companies, profitable businesses, putting that in your portfolio. It seems really simple, but you'd be astonished as to how many companies that don't meet that criteria that get into your portfolio from other advisors or in large funds that you can find within your portfolio to try to, achieve some level of growth when you don't need to take that extreme level of risk to come up with some good solid profitability. And I think we provide you with the research, which is our focus to find those companies, but also a strategy on how many stocks you should own in your portfolio and what makes sense in terms of constructing a portfolio over what period of time. And it comes from our couple decades of experience in the industry. So hopefully we can pass that on. And I'm excited for the upcoming seminars. It should be a good time. The Q&A sessions are quite good and quite lively. So it's
gonna be great. I'm excited too. And you want to know what? Yeah. I can keep going on and on about it, but I'm gonna save it for the events.
We will, for sure. Let's get into Your Stock, Our Take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Company we're going to talk about comes in from a question emailed in from the Moore family. It's on GlobalSCAPE, symbol GSB on the New York Stock Exchange. It's a company they said you had recommended to us in the past. The stock jumped this past week. Any thoughts? GlobalSCAPE, like we said, symbol GSB on the New York Stock Exchange, currently trades at $585, market cap just over $100 million, $105 million. What does the company do? Well, they call themselves a global pioneer, but we'll just say they develop and distribute software that delivers managed and host solutions and provides associated services for secure information exchange, data transfer, and sharing for enterprises and consumers across the world. The solutions essentially are in the area of managed file transfer. They securely transfer large files for large corporations, small and mid-sized as well. The stock jumped 30% last week. Let's look at what's driving that growth. Well, the fourth quarter results came in. Revenues rose just under 5% to $9.28 million. But it is the net income that really drove the stock. Net income was up to just under $3 million, or around 17 cents per share, compared to a net loss of just under $200,000 in the fourth quarter of 2017. Adjusted EBITDA was up to $4.6 million from $1.4. So you can see extreme growth in terms of EBITDA and in terms of net income. So in early 2018, GlobalSCAPE restructured its operations with the aim to increase revenue, reduce operating expenses, and deliver greater profitability. Sounds like a simple plan, and a plan that most companies should do, but there were some doubts as to whether management could execute on it. Now, we compare the fourth quarter results to the same period in 2017. We did that above. We saw, decent revenue growth, but not extreme. Operating expenses declined 43% in the quarter, and the company went from a net loss of $200,000 to a profit of $3 million. So 2 of the 3 were very successful. Operating expenses decreased and profitability was up as a result. Revenues increased just marginally, though, around that 5 to 6% rate. The biggest part of the decrease in operating expenses was an over $1 million decline in legal expenses from legal issues the company had in the same period last year. The reduction in legal issues should continue going forward. Now, if the company continues operating expenses in line, continues them at the current rate, and revenues can begin to increase at a higher rate, the company offers good speculative value. Again, this is if the company can repeat that, say, 17 cents it earned in the last quarter. The company, if it can do that, is likely trading at under 10 times earnings and probably offers some speculative value. It does have some attraction based on its balance sheet as well. So in this range, if the company maintains that earnings momentum that we saw, there is some value in the business for sure.
So is this something that you're looking at more seriously right now?
Yeah, I mean, it is a company we've owned in the past and, had a decent gain, and we sold some shares. But that quarter was, in terms of profitability, it was a step up for the business. We just have to look to see, some of the things that we'd look at is whether or not there's a little bit higher than 5 to 6% revenue growth. We'd like to see an acceleration in terms of revenue growth. And it looks like there's a plan in place, but in the past, management has had a plan in place and not exactly checked off all of our boxes in terms of executing on that plan. So we'd have to see maybe a quarter again of them execute and bring the earnings that they brought in the last quarter. They did do what also is juicing earnings per share on a per share basis is they did a modified Dutch tender, last year. 4.9 million shares they bought back. So that's automatically reducing the outstanding shares by 22.4%. So that is going to lead to an increase in earnings per share over the next year if they can continue to be profitable like they were in Q4. Again, the balance sheet is good, $9.2 million in cash, no debt. So it checks off a lot of our boxes. It would just, for it to be a full recommendation, I'd just like to see a higher growth path of, higher than 5 or 6%, at least getting above the 10% growth rate, and that would really attract us. It does look like a company that may be a takeover target. There was a company that looked at a purchase of this company around a year ago. So, it has some interesting technology. It's a, cash-rich balance sheet, and, it does provide some solid profitability. So it does have some potential as a takeover target. We don't typically make a buy on a company just because it has the potential to be taken over. We'd like to see. The only thing this company is really lacking right now is a huge growth driver. It doesn't have that. It probably has some spec value as a value situation over the next year. Now we're going to look at our weekly star, and we're going to look here at North American Construction Group Limited, symbol NOA on the New York Stock Exchange. Aaron's going to handle that one.
From our Stars and Dogs segment, it's time for this week's Star.
Thank you, Ryan. So our star of the week, North American Construction Group, formerly known as North American Energy Partners. So the company provides mining and heavy construction services to customers in the resource development and the industrial construction sectors, primarily in Western Canada. Its core market is the Canadian oil sands, and it provides services like site clearing, access road construction, construction and relocation of mining site infrastructure, heavy equipment and labor supply, material hauling. So it's essentially like an oil and gas services construction stock. The company is up about 10% since it posted its Q4 results a week ago last Monday. But the stock price has also nearly tripled over the last year, growing from $6.50 per share to over $16 per share today. And this is especially impressive considering that it's been a relatively weak resource market. The NOA posted very strong financial results for the full year, growing revenues 40% and EBITDA by 61%. And that momentum continued into the fourth quarter, with revenue increasing 60% to $131 million and EBITDA increasing 57% to $28.4 million. In spite of strong growth in operating earnings, the company's earnings per share only grew very slightly in the fourth quarter, from 9 cents to 10 cents per share. And for the year, earnings grew from about 18 cents to 54 cents per share. So very good growth in earnings per share over the year. But at the current price, higher valuation, with the stock trading at over $16 per share today, you're looking at a valuation to earnings of about 30 times, a little over 30 times. Looking into 2019, management's outlook is extremely positive, and they are expecting growth of 70% in revenue and 60% in EBITDA. They believe that they can potentially achieve earnings per share of $1.60 in 2019. So that would be a valuation of about 10 times earnings, certainly a lot more attractive. There are two areas of concern, though, that I do have. Firstly, the financial performance historically has been quite volatile, and we have seen big fluctuations in revenue and years of no profitability. They did just complete the second year of a 3-year growth plan, so they may have made changes to the operating structure to drive better consistency, but that is a concern, especially in the area where they operate, oil sands. It can be very cyclical, very volatile, very commodity price driven, and we don't want to invest in a company that is just basically going to see revenues and earnings fall off a cliff once they complete certain contracts. We want to make sure that they have sustainability of that performance. My other concern is the debt, which currently sits at about $385 million. I think that relative to the EBITDA, the debt leverage is quite high, and that is a risk going forward as well, particularly given, once again, that they operate in the resource sector. But they had very stellar results for the year, and I do like the outlook as well for 2019. So this is not something that I would rush out and buy a big position in right now, but it is an interesting story, and we are doing a much deeper dive into this stock for our clients currently.
All right, that's a good summary. I think, like you were saying, with any company that has exposure to a cyclical sector, we would definitely, we just caution on whether or not, even if it's trading at 10 times earnings going forward, those earnings can fall off a cliff. They can be boom and bust. So it's very difficult for us to do anything other than a spec type buy on a situation like that. It's hard to be a long-term investor in a company that services a sector that is very cyclical. All right, I think that's going to wrap it up for us this week. Again, I'd like to remind all our listeners to come out to our spring workshops, our seminars. Kelowna, April 15th, 7 p.m. till 9 p.m. All of them are 7 p.m. till 9 p.m. Again, we stay after an hour at least to answer questions. Victoria, April 16th. Langley, April 17th. Vancouver, April 23rd. Edmonton, April 24th. And Calgary, April 25th. Thank you. Keep your questions coming in for Your Stock, Our Take segment via Twitter or email or the regular social media channels. Again, Aaron, I'd like to thank you for co-hosting and Profitable Investing.
Thank you. Profitable Investing.